Thank you for joining us today. I'm Michael Saylor, the Chairman of Strategy, here with our CEO, Phong Le. At the upcoming shareholder meeting in June, we're putting up for a vote an amendment to modify the dividend frequency of STRC from monthly to semi-monthly. I'm going to update you on the status of Stretch, and Phong is going to discuss that amendment, how it would work, and why we think it's in the best interest of all of our shareholders. I'd like to start with a few Stretch highlights. Stretch has been enormously successful. It's having a great year. It's one of the fastest growing, most successful credit instruments ever. In fact, of all the credit instruments we've created, and we've created quite a few of them, Stretch is the one security that I recommend to my friends and my family. And the reason why is it's got this rare combination of high yield, low volatility, and high daily liquidity. It's very simple to understand. And you can see on this dashboard, the Sharpe ratio of Stretch is 4.5. The volatility has hit 1.7% as of the early part of this week. Daily liquidity is marched forward. It's now $339 million a day. That's really quite extraordinary. I mean, the average daily liquidity of a preferred stock can be $1 million a day. So it's orders of magnitude better. Stretch is over collateralized by 4.3x. So $4.30 worth of Bitcoin for every dollar of Stretch outstanding. And so what's the result of that? Just tremendous growth, a lot of market enthusiasm. Now, how does Stretch compare to other credit instruments? Well, 11.5% yield is really the headline, and it's 3x more yield than you get from a money market. It's almost 2x what you get from many other corporate credit instruments or bank preferreds. And of course, if you pay taxes as a retail investor or corporate investor, then the return of capital dividends is a big advantage to you. It results in a tax equivalent yield of 18% or even more. That combination of the high yield combined with low volatility creates a tremendous Sharpe ratio. And you can see here the Sharpe ratio of Stretch, the return minus the risk-free rate divided by the volatility, is an order of magnitude better than comparable credit instruments. That Sharpe ratio is even stronger than traditional equities. If you look at the performance of the Mag 7 equities over the past 5 years, and what we call the Bitcoin standard era since August of 2020, you can see that only NVIDIA is outperforming its volatility. Stretch, on the other hand, more than 2x NVIDIA. And we benchmark Stretch versus asset classes, and most asset classes over the last 5 years aren't outperforming their own volatility. And so you can see BTC and the S&P index are 0.83, Stretch 4.5. And so Stretch is just a really tremendous financial product. The result of that is, no surprise, it's growing rapidly. From the IPO up to $6.5 billion in less than a year. And with that rapid growth in AUM is a rapid growth in liquidity, almost by a factor of 10x over 5 months. We've done everything that we can to decrease the volatility of Stretch, and we have many different levers to do that, including adjustable monthly dividend rates and at the market shelf registration. Now, the result of that was volatility falling from 13% to about 2% since the launch. But we're thinking, how do we decrease the volatility even more? Just like we're always thinking, how can we improve this credit instrument? And we've decided that if we double the frequency of the credit instrument, it'll make it twice as good. So to discuss the details on that and explain how it will work, why we think it's a good idea, and what the benefits would be for our shareholders is Fong Lee.
Thank you, Michael. As Michael says, Stretch is the most successful credit product that's been launched, arguably, in the history of the world. And as you've seen with strategy over the last 6 years, our goal is to constantly innovate in the Bitcoin space and the digital credit space. And so our proposal reviewed the dynamics of Stretch, especially around the record date, and said, how can we do better and how can we improve? The first thing you'll note is the liquidity of Stretch, which has increased nearly twofold every single month for the last 4 months. But that liquidity increase is primarily driven right before the record date. You saw this happen really over the course of the last week in a very pronounced manner. And our goal and our objective, if we want to decrease the volatility, is to flatten that liquidity over the course of the entire month. With that increase in liquidity, the next thing you'll see is that our ATM velocity, our ability to raise more money using Stretch and buy Bitcoin, drops also after the record date. Last week, we raised $1 billion. We've had a very successful week this week. And as we approach the record date, in this case, it's April 15th or the 15th of every month, after that date, the velocity drops and then accelerates again as we approach that record date. And this is also something we'd like to flatten out. And the final piece here that affects the price of Stretch and the volatility of Stretch here is also the record date dynamic. You'll see here that day after the record date or the ex-dividend date, April 15th, March 13th, you see an average drawdown of about 45 cents, and that builds back up to par over the course of the month. So what is our proposal? What are we proposing we do to improve Stretch and to reduce some of these dynamics around the record date? We're proposing to pay Stretch dividends semi-monthly. So the dividends go from being paid once at month end to twice on the 15th and the end of the month. All other economics of the instrument are unchanged. What do you think? What do we think this will do? This should stabilize the price. It'll dampen the cyclicality. It'll drive further liquidity, and it'll grow demand. We went through dozens of iterations of the best way to go about doing this. And we even thought about weekly record dates, daily record dates. And one of the pieces we had to work around is that the NASDAQ rules limit the frequency of record dates. Precisely from the declaration of the dividend, which we have at the last day of the month. You need to have 10 days before the record date to give shareholders time to absorb that change and make a decision on whether they want to change their ownership of the instrument. So what does this look like on a 12-month basis? It's fairly simple. We go from paying our annual dividend, currently 11.5%, 12 months, 12 times a year to 24 times a year. So from month end to the 15th and month end. What does this look like on a monthly basis? On the next slide. What this looks like on a monthly basis is currently the cadence is we announce the dividend on the last day of the month. So that would be January 31st, February 28th, March 31st, April 30th. We record the shareholders of Stretch on the 15th date of the month, and we make payments on the last day of the month. That's the current cadence. The new cadence just doubles that frequency. We would still only announce a dividend once a month, the last day of the month. For example, March 31st, we would record the shareholders of Stretch on the 15th of the month, and we would pay the dividend to those shareholders on the 30th of the month, April 30th in this case. And then on that same April 30th, we'll record the shareholders and we'll pay the dividend to them on May 15th. So we're doubling the frequency, doubling the cadence. The economics are unchanged. How will this amendment work? Today, we filed our preliminary proxy with all of the proposals to our shareholders that will then vote up until June 8th. On the 28th, we'll file our definitive proxy. There will not be, in our expectation, any material changes between April 17th and April 28th, but that'll be the final proxy. Voting will open. We'll have a regularly scheduled earnings call on May 5th, and then voting will complete on June 8th. We'll tabulate the votes, and we'll make the changes accordingly. So benefits. Well, why does this matter? Why do we think it's beneficial to stretch shareholders and to MSTR common shareholders and to Bitcoin? I think a good analogy here is both a musical analogy and a physics analogy. We are moving stretch an octave higher, right? When you double the frequency of a musical note, the musical note stays the same, but it moves an octave higher. What happens is you increase the clarity of that note, you increase the brightness of that note, you increase the brilliance, but the note stays the same. This is what we're doing with stretch. Same yield at this point in time, 11.5% annualized, and we'll increase the frequency 2x. We think that increases the clarity, the brightness, the brilliance of the instrument, and effectively makes it 2 times better. How does this compare to the world of preferred securities and overall equities? If we look at all of the preferred securities worldwide that have more than $50 million in market cap, there's 921 that pay a quarterly dividend, representing the vast majority of the total market cap of preferreds, $260 billion. If you look at just ones that pay monthly dividends, there's 32 that have a market cap of $3.6 billion. If we were to include stretch in that currently, that represents 65% of all of the global preferreds that pay monthly dividends. If we were to move forward with paying stretch semi-monthly, we would be in a category 1, the only preferred in the world that pays semi-monthly dividends. We think this is unique and this is attractive. What gets more interesting is if you look at all equities that pay dividends in the world, and this represents a market cap of $150 trillion, 500 times bigger than the market size of preferreds. And we think ultimately stretch could address this market cap too, which we'd be quite excited about. And in this universe, there's 24,000 equities globally that pay quarterly dividends. There's 176 that pay monthly dividends, representing $304 billion. And stretch compared to equity universe, the dividend paying equity universe, would also be the only one that pays semi-monthly. We're excited about creating something that's completely unique in the equity capital markets. So we will go to vote on this proposal to both stretch holders and our MSTR common holders. Why is this favorable to stretch holders? We'll match the bi-monthly US payroll cycle. So people are used to getting paid in their payroll from their jobs twice a month, 15th and the end of the month. And this will be very similar to that, and it'll be an analogy that matches that exactly. The ex-dividend date price drawdown that I mentioned before, about 50 cents we've seen so far this month, mathematically, you could expect that to be cut in half. That would reduce the volatility of the instrument. We think a low volatility will increase the liquidity. It should also drive stronger demand. Also, if you're a shareholder, this gives you more entry and exit opportunities. Some folks might wait until the 14th of the month to buy stretch, be recorded as a stretch holder on the 15th and get paid at the end of the month. Now there's just more opportunities to get in and out of the instrument, which we think will also drive more liquidity. And for those who are reinvesting the dividends, whether it be in some other instrument or hopefully stretch, you'll have faster dividend reinvestment time, reduced lag, and as a result, a little bit more economic benefit from the instrument. There are a set of indices worldwide that look for low volatility securities. If we can take the volatility from 1.7 down further, this should unlock the ability of stretch to go into those indices and unlock further passive demand. We think one of the big opportunities for stretch is to borrow against it, right? And when borrowing against an instrument, what are banks looking for? They're looking for low volatility, high liquidity instruments. And if we are able to improve the volatility and liquidity. We think it will improve the collateral utility of Stretch, and that would result in improved haircuts and advance rates. So we think this is very favorable to Stretch holders. We don't think there's any downside. If you're an MSTR common holder, this should also be beneficial. We'd be the only company in the world continuing to prove our digital innovation that pays semi-monthly dividend-paying preferred instruments. Strengthening Stretch should have competitive advantages for us versus other like instruments and other prefers and other equities. And higher Stretch demand ultimately results in higher amplification and higher Bitcoin per share, which leads to higher Bitcoin yield, which is ultimately the KPI that our common shareholders care about. If we have higher Bitcoin yield, that should drive higher MNAV, which will in turn, because we pay for our dividends using our MSTR common, should in turn lower the cost of capital of Stretch overall. And if you've seen over the last few weeks, this will drive more capital into Bitcoin. And that should support Bitcoin price. Just in the last week, we bought $1 billion of Bitcoin. And overall, ultimately, all of these changes will accelerate the growth trajectory of Strategy as a company, which obviously we're very excited about. What happens exactly if this vote was to pass? The first record date, if the vote was to pass on June 8th, will be June 30th, and the first payment date will be July 15th. So from June 8th, roughly 1 month later, the shareholders of Stretch will already start seeing accelerated dividend payments and the increased frequency. So we'll implement this essentially immediately. So in conclusion, Stretch is the most transformative, not just digital credit product, but credit product the world has ever seen. We're uniquely a high yield, high liquidity, low volatility, low tax digital credit security. And now with this change, this amendment will make it the highest frequency credit instrument in the entire world. And of course, we think this will benefit the entire ecosystem. We have today layer 2 digital credit innovators building on top of Stretch. This will improve their ability to build transformative products. This will be better for Stretch investors. This will be better for MSTR investors. And ultimately, this will be better for Bitcoin investors. Stretch is the digital transformation of credit. We have seen it be tremendously successful in the last 8 months. We're humbled and we're excited about the success. This amendment will just make it better. This could make Stretch twice as good as it is now. And so with that, thank you so much for your time. We'll be in communication, I expect frequently over the next several months as we lead up to June 8th.